Every time the Federal Reserve meets, ES and NQ futures can swing hundreds of points in minutes. If you don't understand why, you're trading blind. So let's break down exactly what happens to the markets when the Fed raises rates. First, the basics. The Fed controls short-term interest rates. When they raise them, borrowing gets more expensive for everyone: businesses, consumers, and the big corporations that make up our favorite trading indices. This has a direct effect on ES, which tracks the S&P 500, and an even more pronounced effect on NQ, the tech-heavy NASDAQ 100. Here's the core relationship. When rates go up, stocks generally go down, but the why and the how much vary wildly between ES and NQ. NQ often feels the heat even more than ES. Since NQ is dominated by growth and technology, these companies are valued differently than the broader market. Much of a tech company's value is based on expected future earnings. When rates rise, the discount rate applied to those future profits goes up. In plain English, a dollar earned 10 years from now is worth less today. This is why you'll often see NQ drop faster and harder than ES on a hawkish surprise. ES has more value and defensive stocks that can weather rate hikes a bit better than growth tech. But here's what most beginners miss. The market doesn't react to the rate hike itself. It reacts to whether the hike was expected. The Fed telegraphs its moves months in advance. If everyone expects a quarter-point hike and that's exactly what happens, ES and NQ might barely move. It's already priced in, baked into the current candles you see on your screen. But if the Fed surprises, hikes more than expected, or signals more aggressive moves ahead, that's when things get violent. This gap between expectation and reality is what fuels the big moves. This is the concept of pricing in. By the time the Fed chair steps to the podium, the expected outcome is already in the price. You're trading the delta, the surprise. There's another huge piece: the press conference. Often the words spoken after the decision matter more than the decision itself. This is where the vibe of future policy is set. Traders hang on every word. A single hawkish sentence leaning toward higher rates can sink ES and NQ in seconds. A dovish tone leaning toward lower rates can spark a massive rally. Beyond the presser, traders watch the dot plot. This chart shows where Fed officials expect rates to be in the future. If the dots shift higher, it signals a higher for longer path, which is toxic for tech and NQ. The volatility gap between ES and NQ is massive on Fed days. While ES might move 50 points, NQ can swing 200 or 300. You have to adjust your position size accordingly or get wiped out. Some traders prefer NQ on Fed days because the volatility offers more opportunity. Others stick to the slower pace of ES for better risk management. But the best move? Watching the relationship between both. The honest answer for beginners? Often you don't trade it. Fed days are some of the most unpredictable sessions of the year. There's no shame in sitting out the initial chaos. Many experienced traders reduce their size or step aside entirely, then trade the clearer trend once the dust settles and the market has fully digested the Fed's message. So that's the Fed, ES, and NQ. Rates up generally means stocks down. Tech feels it more, and the surprise matters more than the decision. Understand these mechanics and you'll trade Fed days with confidence. If this helped, subscribe. Every week we break down futures in plain English so you can trade with an edge. Points and ticks. Check the link in the description for our free weekly recap. I'll see you in the next one. Points and ticks.